Welcome back, everybody, to the series on property, plant, and equipment. At this stage, we have responded to the question thus far. We've journalized our PPE journals, and we've also disclosed the revaluation surplus in our statement of changes in equity. The next step is to disclose our deferred tax asset or liability. Here is your fact pattern once again. Refer to part 3 of the video series for more information around how we've interpreted the fact pattern. Using the information available, prepare the following notes to the financial statements for the year ended 31 December 06 in accordance with International Financial Reporting Standards, property, plant and equipment, as well as deferred tax for 11 marks. Accounting policies are not required. In this video, we will cover the deferred tax note. In the next video, we will cover your property, plant and equipment note. While the questions required mentions that accounting policies are not required, comparative figures are required. Thus, you need to include info as at the two salient balance sheet dates being 31 December 06 and 31 December 05. By now you should be familiar with the full deferred tax table on the screen. Our deferred tax liability ends at 30,000 on 31 December 06. I've hidden all the irrelevant columns as your focus should be purely on the deferred tax column as well as the rate column. Let's begin by disclosing these figures in our note. You start off by looking at your balances at the two balance sheet dates. As at 31 December 06, our balance is 30,000. So there you go. The 30,000 will go straight into our deferred tax asset or liability note under the PPE subheading. Next, as at 31 December 05, there was a rate change. And due to the rate change, our balance moved from 17,500 to 15,000 rands. But in terms of the disclosure in the note, I'd like you to take a moment and think, which amount should we use? Should we use our deferred tax liability of 17,500 being the old amount at a rate of 35%, or should we use the amount being 15,000, which is at the new rate of 30%. Take a moment to think about this. So the rate that you need to use, or rather the balance that you need to disclose as at 31 December 05 will be 17,500 and not 15,000 rands. Okay, and remember that when you account for a rate change, the rate change movement is always accounted for in the new year. Thus, when you account for your balance, the balance is always accounted for at the old rate. So you have Part D, deferred tax asset or liability. The deferred tax balance is caused by temporary differences relating to property, plant and equipment, 30,000 as at 31 December 06 and 17,500 as at 31 December 05. The next part is to include a reconciliation of your deferred tax movement on PPE. In order to do this, we go year by year. So we are aware that as at 31 December 05, our balance is 17,500. But what is our opening as at 1 January 05? Since we've evenly accounted for depreciation and wear and tear over the first 24 months of us holding the asset, you can easily presume that from the 17,500, deferred tax liability balance as at 31 December 05. Half of it arose in 04 and the other half arose in 05. Thus, your closing balance of 17,500 in the year 2005 is split into a movement in the current year of 8750 and an opening of 8750. You then roll forward your opening from 31 December 05 of 17,500 to 1 Jan 06 of 17,500. Now that you have your 2005 column sorted, now let's focus on 2006. The next step is to account for your movement pertaining to other comprehensive income. This is an easy one, as 36,000 moved in other comprehensive income. You then disclose that in the note. The next part is to disclose your closing balance of 30,000 rands. That is a given. You can take it from the table on the left or from the top. And your last part is to disclose your movements in profit or loss. That will be a balancing figure of 23,500. We always account for the movement in profit or loss last, as generally 90% of all of the movement in temporary differences pertain to profit or loss, and it's a small portion that pertains to OCI. So profit and loss is generally always the balancing figure. You can either do it this approach, where you have profit or loss as your balancing figure, or you can easily sum up the cells that are shaded in light yellow as well as dark orange. But remember to ignore the 36,000. So you would sum up 2,500 plus 2,250 plus 19,500 plus 1,350 minus 2,100 to give you a total of 23,500. There you have it, people. This is your final note on your deferred tax asset or liability. The rate change of 2,500 is not disclosed in your deferred tax asset or liability note, but it is disclosed in your deferred tax profit or loss note. I hope that you've enjoyed this video. Please like and subscribe for more.